Hey, AgEcon, welcome to our next lecture, which is focusing on the Federal Reserve and monetary policy. So, in our previous lecture, we learned a little bit about fiscal policy. And fiscal policy, as you can recall, is the government influencing money through taxes, and whether we're inflation or stagflation or depression, we can use taxes to help mitigate and fix that. But we can also influence the economy through monetary policy, and that influences how much physical hard money is in the hands of banks and in consumers. So we're going to talk about monetary policy today, and that lends itself perfectly into the Federal Reserve, which some of you may or may not have heard about before. But if you've gone to a bank or if you have invested money in maybe some stocks, the Federal Reserve is a pretty good link to that. So it's important that we know about that in an agriculture econ course. So join with me today as we go over these learning objectives. So our first one, we'll be able to define and categorize the assets that fall into the M1 and M2 categories. And these are different frameworks that help us visualize how much money is in the economy. Number two, you'll be able to describe the organization of the Federal Reserve System. And number three, you'll be able to suggest and defend monetary policies to be enacted by the Federal Reserve when given a scenario. All right, so you're probably wondering maybe what is money, right? It seems kind of simple, but if I pull out a $20 bill, that's money, right? But I mean, what really is money? Money is anything that is generally accepted as a final payment of goods or services, okay? So the purposes of money, there's three of them listed on the screen. The first is a medium of exchange. It can be used to purchase goods and services. So when I go into a Quick Trip and I buy a gallon of milk, or I purchase a hot dog or a slushie or whatever I'm getting at Quick Trip, I am paying money in exchange for a good that I am receiving. Or if I go to Valley Fair and I purchase a wristband to go in the water park or on the rides, or maybe both throughout the day, I am paying money as a way to get that service, okay? Second is unit of account. It can be used to compare the value of different goods and services. So maybe that $3 or $2, $1, however much I'm paying for my gallon of milk, depending on if it has chocolate or it's just normal white milk. Maybe that milk is more or less valuable to me than paying $2 for a hot dog, right? So money is a comparative unit of account when we're comparing apples and oranges or two different products, so we can help decipher what's more valuable or not valuable for us in the market. And the third, store of value, can be held to buy something in the future. So we can take that $20 bill and save it for a rainy day and push it aside, maybe save it for a college fund or maybe getting a new car. I know it's a lot harder to save money than it is for us to go out and spend, but we'll talk about that in a couple lectures when we review personal finances. Okay. So this brings us to a couple of key terms. So an asset. You guys may or may not have heard about this from your folks at home, but an asset is something that we have that adds value or economic value to a company or individual. So for example, your house, if your family owns that house, it is considered an asset, right? If you own a car and it's all your car, like you paid for it, you don't owe any money on it or anything, that is an asset to your name, okay? A liability, on the other hand, is something that is owed or loaned. Okay, so if you are paying rent, or if you are have loans, or you have notes payable, things that you are to be paying out, that is a liability. But if you are receiving something like a note receivable, that will be an example of an asset. So if somebody is going to be paying me in the future or giving me a check, that is an asset for me. But if I owe something to somebody else, that is a liability. So when we hear something like a comment of you are an asset in the workplace, that means you are a tremendous value adder to that workplace. So that's kind of a why people say that sometimes. The third term I want you to know here before we move on to M1 versus M2 is liquidity. So liquidity doesn't necessarily mean that, oh, we're just going to throw this money in a blender and it's going to become liquid when we add some water or milk or whatever to it. No. That's not what that means. An asset's liquidity refers to the ease in which it can be converted into cash. Okay, so cash money is the most liquid of all forms of assets, okay? But something like a check or some type of note that we're receiving could easily be converted to cash if I go to the bank. So some things are more liquid than others. Okay, so we're going to talk about that a little bit later in the class as well. But when defining an asset's liquidity as the ease of conversion into money, M1 is completely liquid. So when we talk about M1 versus M2 on the next slide here, we are going to see that. Okay, M1 is known as the narrowly defined money supply. Okay, so anything that is, boom, this is pure money, that is M1. This is the sum of all coins and paper money in circulation, plus some types of certain checkable deposit balances at banks and savings institutions. Okay, so we're not going to go in depth of what is and what is not considered certain checkable deposit balances because that's over our heads at this point, but just know that M1 is completely liquid. Where we start to get a little complicated is M2. So M2 is the broadly defined money supply. So this is the sum of everything in M1 plus all types of checking account balances, plus most forms of savings and account balances, plus shares in money market mutual funds. Okay, so M1 plus all of this stuff is M2. So M2 is going to have a lot more value to it than M1 because M2 is broadly defined. So therefore, you guessed it, M2 is not completely liquid. Okay, it's a lot harder for us to convert money mutual funds or shares or account balances for some types of accounts into money in some types of situations. So it's a lot harder for us to convert that into cash than it is for us just to take 4 quarters and go to the gas station or go to a bank and put it in a coin machine and get $1 from that, okay? So there you have it. I would write this down so you know the difference between M1 and M2. So the money supply then, when we're looking at this overall, is the currency in both coins and paper money in the hands of public plus checking type accounts. Okay, so currency makes up 48% of total, and checking type accounts make up about 52% of the entire money supply. So the diagram over to the right kind of shows the differences there. We're only going to be focusing on M1 and M2 in here though. The supply of money in the economy is important for price stability and economic growth. So economists want to consider how much money is located in this economy at any given moment and compare that from one time to another time to maybe see what changes are necessary in terms of monetary policy. And we'll talk about that here a little bit. So this diagram, if this confuses you, or after I describe it, maybe just wipe it from your brain. I personally am not the biggest fan of this diagram because I'm not this type of learner, but I'll kind of walk you through the way I see it. So let's assume that you deposit $1,000 into your checking account. So you go into the bank and you just turn in $1,000, right? So of that $1,000, 900 is going to be able to be distributed to other people who come to the bank, right? And $100 are going to be held in a vault in the reserve at that bank, okay? So they're going to hang on to 100 of it, and they're going to send out 900 of it, okay? Your $1,000 deposit then, minus the $100 in reserves, leaves you with $900. And this $900 is going to be given to Elaine, okay? And Elaine, let's say that she owes Joshua $900 for rent or for something else. Joshua is then going to take that $900 and put it in his bank. And then of that $900, 10% is going to be kept in reserves, as we saw from previous. So $90 is going to be held back in the vault in that bank, and the other $810 is going to be sent back out to the economy to another customer. So let's say Joe goes in. Joe is going to get that $810 that Joshua had originally given him with that $900. Does that make sense? So the bank withholds approximately 10% according to this scenario to keep it in reserve, so it has it on hand in case people need to, if we need to match it or anything. But this is going to total up to $2,710 overall because in the economy, because we started with our 1,000, then we gave out 900, then we gave out 810, 2,710. So you can kind of see that at this point, just simply off of that $1,000 investment that you turned in, you've generated $2,710 overall in the economy. That's $1,710 additional than what you had already given in. And that's because the bank is able to hold things in reserve and then distribute that additional money. So again, if this does not make sense to you, just know that the bank is able to hold a certain percentage in reserve, and then they're able to distribute the rest of it out to people like you and me to loan or take out from time to time. Okay. All right, so now we get into the Fed, and I think the Fed is pretty darn fascinating in my opinion. The Fed is broken into a variety of different sections or wings that we're going to look at today. The Federal Reserve banks are the 12 regional banks that are located in major cities, I should not say major banks around the U.S., major cities around the U.S. So there's one, as a matter of fact, in Minneapolis. I believe there's one in Kansas City. I think there's one in San Francisco, Dallas, Texas. Like all of the major cities have a bank, right? And each of these banks has a president that's chosen by the bank's board of directors. And we'll talk about that in a little bit. But this president is responsible for working with the national Fed, the whole big Fed, the board to discuss current economic trends or situations in their area. The board of directors is drawn from local businesses and the banking community. And the Federal Reserve Bank and the system was created in 1914 after a series of bank failures. So the Federal Reserve Bank essentially creates consistency and continuity in how banks operate around the United States of America. Okay, so we start with our 12 regional banks. Then we get our Federal Reserve Board of Governors, and this is the group which oversees the Federal Reserve as a whole. There are 7 individuals who are governors on this board, and they're appointed by the United States President. So right now that would be President Donald Trump. And this is confirmed by the U.S. Senate. So they have the ability to confirm and approve these 7 individuals. And these members serve 14-year terms. Okay? The U.S. president then appoints the chairperson to a 4-year term. So the chairperson comes in and they are the chair for 4 years. And then after the 4 years are over, they leave the board and then another chairperson is elected at that time. Then my personal favorite is the Federal Open Market Committee, or the FOMC, and this is a very secretive, informal group that meets 8 times per year to discuss monetary policy actions on a regional and national level. It's very special to be on this committee. There's kind of some stipulations. It's basically taking the best of both worlds, as you are able to get the governors that I just talked about from that board of governors, and you're able to get regional representation from those 12 banks. So first and foremost, the bank president of New York is always, always, always on the board. Not entirely sure why, to be honest, but I'm pretty sure if I were just to guess as an outsider, it's to allow for continuity. So the bank president for New York is always on the board. Okay. Then we also get 4 additional bank presidents from around the U.S., and this is rotating on an annual, yearly basis. So I believe in 2020, the Minneapolis representative is on the board. That president is on the board for the FOMC. But then at the end of 2020, that position will be given to somebody else in the U.S. And if you are interested in learning more about that, there is a website. If you just search FOMC, United States of America, you'll be able to see the individual's terms and read more about those people. And then lastly, the 7 governors on the Federal Reserve Board of Governors are also a member of this committee, the FOMC. So it is comprised of 12 individuals at this time. Again, the bank president of New York plus 4 additional bank presidents means for 5 bank presidents total, plus the 7, 5 plus 7 equals 12, according to my math. So that is the Federal Open Market Committee. And these meetings can get very, very serious. They have a lot of different values that they hold to with the FOMC. One of them is secrecy. So these meetings are closed to the public, and they're very intense. Like, they're very respectful to one another, but it's very intense and heated discussions at times. The second value that they have, in addition to secrecy, is punctuality. So their meetings, I believe, begin every morning at 9 a.m. when these meetings happen, and they end by the end time. They don't go over or less. They stick to that time frame. They're very punctual and prepared. It's a lesson that we can have in our classroom too, being punctual and prepared with our assignments and activities. They take that very seriously at the FOMC. The third one is politeness. So they're punctual, they are secretive, and they are polite to one another when they're interacting. They don't talk over one another. They don't bring in a lot of political jargon or issues. They try to keep it as professional as possible. So they're very polite in these types of meetings. These meetings only happen 8 times a year as well. So you can find the complete schedule if you're interested in following that on their website. And then after each meeting, they release some information to the general public in a media conference about what happened. They don't necessarily share all of the details, but the key recommendations for monetary policy that they come up with at these meetings are shared, and within minutes the markets are changing. It's pretty incredible. So maybe if we are in class together during one of these meetings, we can post that on the Google Classroom or Canvas site, and you guys can take a look. They're pretty fun watching those briefings. So again, if you're a visual learner, this graphic will kind of help you. This is the structure of the Fed overall. So we start with their Board of Governors, and then the 12 district representatives or the banks. Again, only 5 of these individuals are going to be on the board at any given time, plus the 7. And then all of the banks are also a part of the Federal Reserve System. They just don't have necessarily as strong of a leadership role in determining the monetary policy, but the data and the money that they do have in reserve is very important, okay, to determining that monetary policy. Okay, so what does the Fed say in these types of situations? When there is too much money that is supplied at a national level, this causes inflation, right? So if we have too much money, that means that the value or the purchasing power, as we talked about previously, decreases because there's more money in circulation. That means the dollar isn't worth as much as it would be if money was tight. Okay, so causes would be inflation. An example would be in Germany after World War I, when the German government printed so much money that prices increased by 5,470% in 1923. That's a lot. That is so much percentage increase. Okay. And then the second would be if there's too little money supplied. Okay. Cause falling prices. An example would be in the U.S. between 1929 and 1933, when the money supply fell by 30%. Many economists agree that this was the major contributing factor to the Great Depression. Okay, so these are both very extreme situations, and in my lifetime, I've only been alive for 22 years at this point, haven't really seen anything this drastic in terms of the national economy, but knock on wood, hopefully I don't in my lifetime. I'm sure I will, though. But the Federal Reserve controls the money supply through enacting monetary policy. There are 3 key tools that they have with monetary policy, okay? Again, the Federal Reserve is the system that enacts these monetary policies, okay? So the 3 tools that they have when there is inflation or when there is too much money or maybe not enough money in circulation, open market operations, changes in the discount rate, and the reserve requirement, okay? So we're going to talk about each of these, and then we'll do some practice, and then we'll be done. So the open market operations are when the Fed buys or sells U.S. government securities to influence the money supply. And a picture of one of those is over to the right, very fictional, but buying securities, so these are these little papers. Bank deposits increase, so banks have more money to lend, and therefore the money supply overall increases, okay? So when the Fed buys securities, we're able to increase the overall money supply. When we sell securities, the bank deposits decrease, so banks have less money to lend. Therefore, the overall money supply decreases. So when the FOMC is meeting and when the Federal Reserve is discussing monetary policy, they have to look at these different monetary policy tools to see which would be the most effective, depending on the current economy, the current states, regional issues that are going on, and they choose between open market operations, reserve requirements, and the discount rate to determine which of these 3 would be the most effective. So this is the first one, open market operations. Second, changes in the discount rate. So the interest rate of the Fed charges on loans to banks is what the discount rate is known as. So when we take out a loan from the bank, we have to pay this thing called interest, which is how much money we accumulate over time, depending on how long it takes for us to pay. It's kind of like a convenience charge, I guess, if you will, because I mean, if you take out $1,000 out of the bank right now, you're really going to be paying them probably, depending on your interest rate, but if it's like a 3% interest rate, you'll be paying $1,030 by the time you pay it off in a year. Okay, you're paying that extra $30, 3% as a convenience fee for needing that $1,000 up front. So when they lower the discount rate for banks, because banks have a discount rate when they borrow money from the Fed, okay, kind of like their personal rate, banks are encouraged to make more loans when the discount rate is lower, and therefore the money supply increases. So if the banks have to pay less money to the Fed when they're borrowing money, they're going to want to have more loans to the public because they have more money on hand. Okay, they're going to be encouraged to make more loans. And when they're raising the discount rate, the opposite is true. Banks are discouraged to make loans, and the money supply decreases because when the banks borrow money from the Fed, they're going to be required to pay more back. Okay, so it's kind of like a supply chain, as we talked about previously with the factors of production and all of that stuff in the beginning of the semester. It all kind of applies. Okay. Then lastly, the reserve requirement is the third tool of monetary policy. This is the minimum percentage of deposits that banks must keep on reserve to back up checking type accounts. So when we saw that example earlier of you going to the bank and depositing $1,000, and then Elaine getting $900 and paying that to Joshua, and then Joshua putting that $900 in the bank, and $810 goes back out into the economy for people like you and me. That 10% that was kind of lost in between was what went into the reserve. So in that scenario, the reserve requirement was 10%. So the bank or the Fed has the power to adjust the reserve requirement, or how much money the bank needs to keep on hand to back up checking type accounts. Okay, so when the Fed lowers the reserve requirement, banks have more money to lend and the money supply increases. When we raise the reserve requirement, banks have less money to lend and therefore money supply decreases. Okay. So now I want you to hit pause and fill out this grid to the best of your ability. Know that money, stock, and supply is the amount of money that is distributed to the general public. Okay. Bank reserves is how much money is on hand in the actual bank. And then the Fed's fund rate is how much money is circulating through the Fed at that time. So I want you to tell me if it increases or decreases in each of these boxes. Okay. So it could look like decrease, decrease, increase, increase, decrease, increase. Like just pick one word for each of these depending on the action taken by the Fed. Okay. So hit pause, fill this in to the best of your ability, and then we'll report back. All right, so now that we've had a chance to fill this in, let's see how we did. Okay, so you'll see here that there is generally a pattern, right? So whenever an action increases the money, stock, or supply, the same is going to hold true for the bank reserve. So if we, let's go to an example that's probably pretty easy for us to follow. So the discount rate, right? So the discount rate, remember, is the percentage that the bank needs to keep on hand, the amount of the percentage that the bank needs to pay back to the Fed when they're borrowing money from the Fed to borrow to the customers, right? So if we lower the discount rate, the amount of money that is going to be circulating into the public is going to be higher, and also in the bank it's going to be higher because they're going to be encouraged to make those loans. However, since the Fed is going to be dishing out money to the banks and to the public because they've lowered that discount rate, the fund rate for the Federal Reserve is therefore going to decrease. They're going to have less money on hand because they're dishing that out to the banks and to the public, right? So hopefully this kind of makes some sense to you. If you want to practice with this, I'd highly encourage it. The assignment you guys will be working through on the Google form is going to be very similar to this. It's going to ask you what happens when we buy or sell securities and how that influence the Fed's fund rate, bank reserves, and money supply. And we'll go through securities, discount rates, and the reserve requirement because those are the three key tools of monetary policy. So hopefully by the end of this presentation, you're now able to define and categorize the assets that fall into the M1 and M2 category. So remember, M1 is going to be cash and coins and things that are readily liquid, right? Liquid is how easily it's converted into cash money. And M2 is going to be everything in M1 plus other types of accounts that aren't as easy to convert into cash right away. Second, I can describe the organization of the Federal Reserve System. So remember, we have our 12 banks that are located around the U.S. One of them happens to be Minneapolis, right here in Minnesota. How lucky are we? And then we also have our Board of Governors, and there are 7 governors appointed by the national government, so the president. And then there are also the FOMC, or the Free Open Market Committee, or the Federal Open Market Committee, and that is what is comprised of those 7 governors and 5 individuals from the regional banks around the U.S., and they rotate on an annual basis. So that's how the Fed is organized, and obviously all of the banks in the U.S., right? They're a part of the Federal Reserve. And then, because we know that inflation happens or prices fall, we need to enact monetary policy. And that third objective does just that. I can suggest and defend monetary policies to be enacted by the Fed when given a scenario. So when we have inflation occurring, or when we have those prices falling or increasing depending on the current situation, we can use expansionary monetary policy or contractionary monetary policy to help balance the budget and the amount of money that's available. So hopefully you found this information to be pretty helpful. I'm a big fan of monetary policy and Federal Reserve myself. I think it's pretty interesting stuff. If it was an in-person class, we'd be doing some debates and some pretty hands-on activities, which are kind of hard to facilitate in an online format. But hope you guys enjoyed. As always, feel free to send us an email if you have any questions or concerns about the content. Thanks, you guys. Have a great rest of your day.